The pace with which the S&P 500 now back at record territory, NASDAQ got there first with Tesla, pretty impressive.
And in fact, I think surprising and probably represents the path of maximum frustration, because even if you thought that the pullback 3.5% from the highs was somewhat justified just to relieve some of the pressures of a stretched market, and the coronavirus scare came along as a means to get that done, I don't think you would have said a round trip would happen in 3 weeks or so.
We begin, of course, with the markets. The Dow's best day since June. Stocks continue to stage that strong rebound. Jim, I guess this is the market saying the virus is a big story, but maybe the worst has passed, or it's not going to be as bad as some originally feared.
Yeah, I think that's a logical conclusion.
I was going to say the reason why the market's up was on display today. He was wearing a suit and he had glasses and he was talking to a bunch of people in the House Financial Services Committee, that being the Fed chairman. Not only him, but the global central bankers around the world. No matter what you throw at the market, Barb, it doesn't seem to matter because the Fed and central banks are here to play and here to stay.
Yeah, I think that's very true. I mean, what we saw, the Fed cutting last year, all the liquidity measures they're taking, all the other central banks around the world. And in fact, when we had that sell-off on the coronavirus scare a week ago, we really thought everybody was afraid, including myself, to really step in and use that as a buying opportunity. So what we've seen then, I think, is telling you the power, not only of our economy, whereas Chairman Powell pointed out today, 85% of our economy is domestic, but that we really have the resilience that even there will be a nick in global GDP because of the coronavirus in China slowdown, but it's going to be fine.
Well, here's a question. Where the heck did all the sellers go? Did they just disappear? Did they simply decide to park the money in the stock market like it's some kind of bank vault? The more I watch this market rally all week, with the Dow gaining 89 points today, S&P advancing 0.33%, NASDAQ climbing 0.67%, the more I think that's exactly what's happening. It's not that investors have gotten complacent. They're just being disciplined and resilient. And so far, that discipline is working, and the resilience, well, it's a wonder to behold. With the coronavirus seemingly contained within China, at least for the moment, I think it's worth asking ourselves, how could we recover so easily from Friday's meltdown? We've now bounced back harder than we fell.
By the we, if we mean the United States,
yes.
Everyone in America should take a very big breath, slow down, and stop panicking and being hysterical. And we are having a little too much histrionics about this. Let's remember, we have fewer than 10 cases in the United States. There are concentrated in 4 states, California, Washington State, Arizona, and Illinois. That's it. Most importantly, there are people coming in from China. There's been no person-to-person transmission.
Yeah, I liquidated my portfolio on SARS. I'm waiting for the all clear to get back in. So it's about 17 years. I'm hopeful that there'll be no diseases ever again and I can invest. Look, as I always say, it doesn't matter whether you buy or sell. The important thing is that you panic. Right, Bob?
That's right.
Obviously brutal. I mean, the markets rushed toward a place to say we have to start handicapping the probabilities of a recession in this country.
Whatever that is,
Right.
what is going to stop this now?
Well, I'm not sure it can be stopped just because we now have so many companies that I think are going to be strapped that a recession certainly, if not on the table, here right now.
Good evening, I'm Kelly Evans.
I'm Scott Wapner. This is the 63rd day of this massive global health crisis.
Yeah, we are here tonight because of the violent market reaction to the very real threat the coronavirus is about to impact this country in ways we have never seen before.
All right. Today is Thursday, September 23rd. This is a recap for the stock market activities today. And folks, I got a good one for you tonight because in focus. Can you trust the rebound? What about the labor shortage and the status of stagflation? The market obviously rebounded higher, a massive rally across the board led by my favorite sectors of the market, the cyclical sectors of the market. We're talking about financials, industrials, energy, materials, and chips. But the main question is, can you trust the rally?
The answer is no.
And why do we say that, by the way? If you want to trust the rally in financials, for example, you need yields for the 10-year treasury, that is, to rise higher and close the week above 1.5%. I'm not going to be mad if it closes at 1.45. That's good enough. But that will be a confirmation that financials are good. Because remember this, I'm overweight the inflation trade, meaning betting that inflation will rise higher and higher and higher and higher. And Papa Jerome Powell came out last night and he said, you know what? We're going to taper someday. And therefore, inflation, you have the green light to continue to rise higher and higher and higher and higher. The inflationary trade consists of financials, energy, industrials, and materials. Perhaps chips included. But since June, I have seen these pops for a day or two, and then they fade away right away. Why? Because we have no confirmation from yields. Yields need to rise higher to confirm the rally in financials. But you also need to see the dollar diving down to confirm the rally in industrials, energy, materials, and chips. The dollar was down today, reversing the move from yesterday. But do we have a confirmation on the weakness in the dollar? Of course not, because the week is not over yet and the dollar is still trading above 93. Perhaps a closing below 93 for the week will be a confirmation that the inflationary trade is back on the table. But for now, I am not trusting this rebound at all, because the decline of the dollar today was attributed to the massive surge in the sterling, because the Bank of England announced in the morning a hawkish stance, projecting that inflation will rise higher beyond 4%, and therefore the sterling rises higher, assuming that the Bank of England will tighten. But remember this, the Fed will also be forced to tighten, and therefore the dollar will continue to rise higher. So I'm not trusting the rally until the dollar is killed. And that leads us to the wall of worry. Why did the market rebound higher? Remember this? On Monday, we had a lot of worries, starting with China, Evergrande, Delta, tapering, Biden, the debt ceiling, margin calls, and the deleveraging due to the rise in volatility indices. So let's get an update here and see what happened. When it comes to Evergrande in China, debt issuers right now are commanding a premium due to the risk of default from Evergrande. What does that mean? It means tightening in lending conditions. Now, is this bullish or is this bearish? The answer is it is bearish, because you're tightening the yayo. You're tightening the coke in the economy. No more easy lending. We're going to have stringent lending conditions. And we're talking about the most important economy in the world right now, China. Do you think this will be contagious or not? Because before they told us that the virus will not be contagious and it is limited to China, like they're saying right now with the Evergrande crisis. But for now, we have a band-aid on our concerns regarding China. Why? Because the the Chinese government injected $18 billion into the financial system. And for now, Evergrande is evading the default crisis. But you can kick the can down the road for so long before you have to visit the issue once again. But for now, the market is jerking off to the fact that the Evergrande crisis is kicked down the road. What about tapering? We're going to place a band-aid on that one too, because Jerome Powell came out yesterday and he said, yeah, we're going to taper soon. Soon could mean November, December, January, February, March, April, May, June, July, 2023, 2024, 2090. It depends. And therefore, Chairman Powell soothed our concerns regarding tapering, at least for now. What about the debacles from the Biden administration and the risk of taxation? Well, this is still going on, and you can bet for more debacles out of the Biden administration. What about the debt crisis, the debt ceiling crisis? We can put a band-aid on that right now because they're talking about resolving the debt ceiling issue, and perhaps eliminating the debt ceiling altogether, suspending the debt ceiling. No more ceiling, debt to infinity and beyond. Now, what about the risk of margin calls and the deleveraging? That's still on the table. But for now, we're not worried about it. We don't have a band-aid for it, but if we stop talking about it, it goes away, right? Now, let's talk about the labor market because this seems to be an important issue that will hit the economy and the stock market. And if you heard the earnings call from FedEx, you know that this is a massive problem, and FedEx will not be the only companies suffering from the labor shortage. Now, we'll show you when we review the IHS composite PMI, you will see that this is a widespread issue across the economy. And I told you in this program over and over and over again that the labor shortage is not due to the $300 the unemployed are getting per week. Nobody is sitting at home not taking these jobs with generous wages and benefits, free iPhones, free cars, free lottery tickets. And I told you that there are more issues here causing the labor shortage and the hesitancy for workers to go back to corporate slavery. And I made a projection that once the enhanced unemployment benefits expire in September, you will see that the labor shortage will not be resolved at all. And now we have JP Morgan, and JP Morgan agrees with me by saying that again, no labor market boost from early end to UI. This is universal income. Surprise, surprise. So all of you critics who told me, bro, you don't understand. The moment the enhanced unemployment benefits that we're giving to the bums, the $300 a week, once you take that away, you're going to see a tsunami of job applications. Bullshit. I don't need an apology, but how about a cookie, a piece of candy, something? And on top of that, by the way, we have draconian vaccine mandates that will perhaps add more pressure on the labor shortage because we have workers who just don't want to get vaccinated for whatever reason. And if the job mandates getting vaccinated, they're going to say no thanks. Perhaps this is a little hint for you on what's causing the labor shortage. I talked to a bunch of frat boys over at college here in San Diego, and the frat boys are rolling in cash. They're showing me their Robinhood accounts. Look at my gains, bro, my meme gains, my crypto gains, bro. Some kid has over $400,000 in his Robinhood account right now. And that was created from nothing. He borrowed $10,000 from his parents, and now he's sitting on over $400,000. And the guy says, I figured it out. I'm a genius, an investment genius. I don't need to take a job right now. Matter of fact, I don't need to attend classes right now. That professor who's teaching me finance, he should drop out and I'll teach finance. Because look at my gains, bro. Does the professor have any gains even close to mine? So long as stocks going higher, the labor shortage will continue to go on and on and on. Because if you didn't get the news today, we are richer than ever before. U.S. household wealth jumped to a new high of $1.41.7 trillion at the end of June. A report from the Fed showed boosted by stock market gains and a pandemic-induced real estate boom. Folks, richer than ever before. Thank you to the Fed and Papa Jerome Powell. We don't need jobs anymore. We don't need government handouts anymore. Oh, wait a minute. We actually need those. But here's the catch. When your home value goes higher, yes, you can refinance, you can take a home equity loan, but you're gonna pay a lot of taxes too. So it's a double-edged sword. When it comes to your stock gains, these are all paper gains. If you're not hitting the cha-ching button, the sell button to book your gains, you're gonna lose your gains in an instant. Poof. One day you wake up and within a week, all of your stock gains are gone. Take, for example, a stock that I own in my portfolio. It's called McAfee. And I bought the stock at the beginning of the year. And I made my case for it on Twitter. The stock took the escalator higher. And I was sitting on gains to the tune of over 75%. Now, not because I'm a genius or a great market timer, but 75% gains in a few months, that was good enough for me. And I took the majority of my position out of the table, as I announced on my Twitter page. And what do you know? The stock crashed right away. And all of these gains that took months and months to build, they were poof, Gone in 1 week. 1 week. That's all it takes, folks. You take the escalator higher and you take the elevator down. So all of this fake confidence that our stocks are higher, we got nothing to worry about. What happens when these same stocks take the elevator down? Oh, I know. Bro, stop it with the FUD. Stocks will never go down. We're going to the moon, bro. Papa Jerome got us. And there is nothing going to stop us. Okay. Maybe you want to pay attention to stagflation. Because if I remember correctly from my college books, stagflation is not good for the economy. And it's not good for the stock market, with few exceptions. So here comes stagflation. We got the market composite PMI in the morning. And the headline reads, private sector output growth hampered by severe supply chain holdups and capacity shortages. So the pace of economic growth is slowing down. But is inflation and prices also slowing down? Let's read the report. Private sector firms in the U.S. signaled a solid expansion in output during September, albeit at the slowest pace for a year and one that was much softer than that seen at the start of the summer. The overall upturn was weighted on by the weakest increase in service sector business activity in the current 14-month sequence of growth. At the same time, new order growth eased to the slowest since August 2020, although demand conditions at manufacturing firms remain very strong by historical standards. The upturn in service sector new business slowed to a 14-month low as COVID-19 concerns persisted. Pay attention to the contrast here. While new export orders increased at a faster pace, the improvement was confined to manufacturing. Service providers registered a solid decline in exports as ongoing virus restrictions continued to impede activity. Challenges finding suitable candidates and difficulties retaining employees were reflected in firms reporting only a fractional rise in employment for a second month. Backlogs of work rose strongly due to the resulting pressure on operating capacity. The rise in outstanding business was the second fastest in over 12 years of data collection, with a record increase seen in manufacturing. And perhaps this is the most important piece. On the price front, input costs rose at a sharper pace during September. The rate of cost inflation was the quickest for 4 months. Pay attention now. And the second highest on record, as supply chain disruptions and material shortages pushed prices and transportation costs up. Meanwhile, output charges continued to increase markedly, continuing to rise at a pace far outstripping anything seen in the survey's history going back to May, as firms sought to pass on higher costs to clients where possible. Ta-da. You and I, baby, you and I, gonna flip the bill. But hey, where is inflation, right? Is it over here? Is it over there? I don't see any inflation. This is what the deflationistas and the transitionistas talk about. And I know what you're saying right now. I don't understand what you're talking about, bro. This is all too much for me, for my little brain. Give me the tickers, tell me which stocks are going to go higher tomorrow, and let's wrap it up already. Perhaps you want to hear from Chris Williamson. Perhaps he'll give you a summary that your little brain can handle. The pace of U.S. economic growth cooled further in September, having soared in the second quarter, reflecting a combination of peaking demand, supply chain delays, and labor shortages. The slowdown was led by a cooling demand in the service sector, linked in part to the Delta variant spread. However, while manufacturers have seen far more resilient demand, factories face growing problems in sourcing enough supplies and labor to meet orders. Supply chain delays show no signs of easing, with another near-record lengthening of delivery times in September. Hence, factory output growth also weakened and order book backlogs rose at a record pace in September. The upshot is yet another month of sharply rising prices charged for goods and services as demand outpaces supply and higher costs are passed on to customers. I know what you're going to say, but bro, the demand is slowing down. Therefore, prices will go down. That's the assumption. But the backlogs and the port shutdowns are still here. The labor shortage still here. The printing is still here. But you know who's not here? The legendary economist Milton Friedman. But if he was here, he would tell you forget about all of this garbage. At the end of the day, inflation has always been, always, a monetary phenomenon. And so long as the Fed continues to print, prices will go higher and higher and higher, and we will end up in stagflation. You stop the printing, and magically, all of these supply chain bottlenecks, shortages, etc., poof, they will go away because the picture is getting dire out there. It's not just the backlogs at ports. You might have heard what's going on at the LA Long Beach port. We're now nearing 100 ships waiting at the port. And now we have rail yards also getting severely backed up. So forget about Halloween, forget about Christmas, and you can thank Papa Jerome Powell, the man who stole Christmas.
This is what the traffic bottleneck looks like at the ports of LA and Long Beach. There are dozens of cargo ships just sitting in the water waiting to be unloaded. That's because the pandemic has spurred an increase in consumer spending. And if you add that to the shortage of truck drivers and full warehouses, this is the result. Experts say all of that will create shipping delays for everything from furniture to electronics to holiday toys.
It's going to be really tight getting access to products for Christmas season coming up. It's going to be a really messy one for consumers trying to find that product. The famous example, nobody can get a PlayStation 5 right now.
Not even Halloween is safe. The CEO of Megatoy says they have several hundred Halloween costumes stuck at the harbor. Port of LA officials say they don't expect things to get back to normal again until at least sometime next year.
You see, the good news is this year, no Halloween. To begin with, nobody's gonna knock at your door saying trick or treat, which I usually meet with a slap in the face. In my household, it's trick or get the f out of my way. We get a candy shortage, in case you haven't heard. But the good news is this year, you don't need a costume, you don't need a mask to scare people away. You're gonna have to go au naturel. You know, your regular face would do, right? It already scares people away anyways. You don't need a mask. And of course, I'm talking about myself, by the way. I'm not insulting any of you guys. All of you guys got beautiful, pretty faces. But me, I got one of them rough faces. Scars, dents, burns all over the place. I don't need a mask to scare people away. But that also means that I will be a good parent. Because when your kids get engaged in wrongdoing, what do? I'll take your Xbox away, bro. Buddy, right? You don't call them son, kid, even their names. It's buddy, right? This is parenting these days. Hey, buddy. And then you wonder why your kid has no respect for you at all. But this is what happens, right? I'm gonna punish you by taking your PlayStation away. No PlayStation for a week. And the kid responds, who cares, bitch? Take my PlayStation away. I'm gonna play video games on my phone. Okay, I'll take your phone away. No, you're not. You're not gonna take my phone away because what if I have an emergency and I have to call you? You see, parents are out of options these days. The kids have the upper hand. But with me, I don't have to take your PlayStation away. I don't have to take your Xbox away. I just have to give you a look, and you're gonna shit in your diaper. You know what that look means, and you don't want to see it, trust me. Back to, what were we talking about here? Oh yeah, financials, markets, economy. Well, now we have ex-Fed officials who are saying that perhaps Jerome Powell already screwed up. And he's behind the game when it comes to tightening and tapering. What does that mean? It means that inflation will go out of whack. If you thought inflation will rise 5%, make that 10. And if you thought it's going to rise by 10, make that 20. And ex-Fed President Dudley of the New York Fed, you know, the fearmonger that he is, what's up with the FUD, bro? We need some positivity here. But the FUD man says this will increase the risk of a hard landing. What does that mean? It means what we talked about last night. The Fed will abruptly have to raise interest rates, and that will nuke the stock market and the economy all together. But do you think Jerome Powell will face any punishment, will go to jail, will pay fines? Of course not. He got his munis. He's going to wait for maturity, go back to the mansion in Florida, and sail away to the sunset. Meanwhile, the bums, the poories, the middle class, they end up holding the bag. And since we're getting new subscribers and viewers by the day, folks, I hear you and I listen to your criticism. You're too bearish, bro. What's up with the FUD? What's up with the scare tactics? We need some positivity here. We need some good news, bro. I got you, and I know, and therefore I'm sharing this good news with you. A new study revealed that almost 1 in 5 Americans drank heavily during the pandemic. And I assure you that I'm not one of those 1 in 5 Americans. Not at all. Trust me, my drinking habits are under control. But the problem is, with all of this misery with the pandemic and the shutdowns and you need a booster or you don't need a booster, the pandemic is over or it's not over, inflation is over or it's not over. We need a lot of booze. We need a lot of liquor to cope with the misery. But here's the bad news. Inflation and shortages are now hitting your liquor store. We have a massive liquor shortage. And people are getting the message and they're hoarding liquor all over the place. So soon enough, we're going to have to go back to old school, making liquor at home. The good old days of the prohibition. They keep telling us it's the roaring 20s, the roaring 20s. Yep, we're going back to the roaring 20s. Just watch out for the roaring 20s to bite you in the ass. But of course, all of this liquor usage and beer drinking from those 1 in 5 Americans, the other 4 are good, but those 1 in 5, they're drinking heavily. And they're driving barley prices to the moon, bro. So stick around because we're going to talk about that and a lot more in the futures market coverage. I'm going to talk about wheat, I'm going to talk about oats, and all the components of your beer habit. On top of that, we're going to talk about lean hogs, aka the new big tech. But before we do that, let's move on to the market's performance today. And here we go. It's Orgasm Day. The Dow Industrial Average closing in the green by 506.50 points, or a gain of 1.48%. The Nasdaq closing in the green by 155.40 points, or a gain of 1.04%. The S&P 500 closing in the green by 53.34 points, or a gain of 1.21%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, energy. And number 2 for the silver, financials. And number 3 for the bronze, industrials. The inflation trade is leading the market higher. Meanwhile, the laggards of the day, utilities, REITs, and consumer defensives. So the defensives are lagging, the offensives are leading. On paper, this is a good day. This is what you want to see from the market to validate any rally. But without yields and the dollar making their move, we don't have a confirmation yet. What about the advance to decline ratios? NYSE 77% advancing versus 20% declining. The Nasdaq 73% advancing versus 23% declining. Yesterday was 80% advancing. We're down to 77% advancing. And pretty soon we'll be down back to 50-50. Exaggerated ratios to the downside, like we saw on Monday, are a good indicator for bottoms. Likewise, when we have exaggerated moves to the upside, when we have 80, 90% advancing, these are all indicators that a pullback will follow. Moving on to futures. What's going on here? Massive gain across the board. Papa Jerome wants inflation to go higher. Here we go, inflation is going higher. Crude oil prices rising higher. Gains of more than 1% for the WTI and Brent. Massive gains for gasoline, heating oil, and natural gas rebounding higher once again. What about softs? The only loser is cocoa futures, down about 1% or so. We have gains here for coffee, cotton, OJ, sugar, even lumber. The transitory one is rising higher. Now pay attention here. The action in metals is telling, because if the dollar is down sharply, as we've seen today, why didn't metals rally higher? Because we have gold down, silver down, platinum down, copper down, palladium down, everything is down. Therefore, you cannot trust the decline of the dollar today. Watch out for the sterling up almost 1% today, the Kiwi up over 1% today. The entire globe is starting to tighten. What about meats? Live and feeder cattle futures on the flat line. Meanwhile, we have massive gains in lean hogs futures. I know it says down 8%, 9%, but this is not accurate because they're just updating the new contract from October to December. And the October contract was about 84 bucks, and therefore it's showing a decline here, but it's not declining. I'm trading lean hogs right now, and I have the December contract, and we were up to the moon, baby, because lean hogs futures rising higher, aka the new tech, the new big tech, triple digits. The December contract was up over 4% today. Here's the chart for lean hogs. The December contract, we had oversold conditions, both the RSI and MACD perspective. We have a defined channel, a declining channel, and we have reached the lower end of the channel. The assumption is lean hogs futures will pop higher and perhaps break above the upper end of the channel. The thupathackle in pigs is about to happen. And my advice is don't bet against the new big tech. Don't bet against the piggies. I mean, they're cute. How could you? How dare you bet against them? Back to the futures. What about grains? What's going on with grains futures? Massive update for oats, our favorite, and also a beer component, by the way. We also have wheat. Not a lot of us into wheat beer, but some people are. Wheat rising higher. Likewise, we have gains for canola, corn, soybean oil, and modest gains for soybeans futures. The decliners, modest declines that is, were led by soybean meal and rough rice futures. Moving on to the big casino, the options market. What's going on here? Notice the volume. The volume is down. What does that mean? The rebound, the pop so far is led by, sometimes the brain wires misfunction. But anyways, the rebound was led by the algos. Low volume, autopilot buying, no retail participation. Because retail, we love to buy options. If the stock market were to rise higher, and we already have the bottom to the moon, bro, we would be YOLOing call options. The volume for options in the market would have been increasing, but so far, the drop in volume hasn't recovered yet, meaning we have no conviction from retail traders, at least in this rebound. Retail traders are saying, no thanks, I want to see a little more before I put my blindfold on and run Naruto style, heads first, asking questions later, buying call options. But anyhow, Apple remains the hottest table in the casino per usual, no surprise here, with about 850,000 contracts, about 61% of those were calls. And at number 2, Tesla, the souffle, with about 800,000 contracts, about 39% of those were calls. You bears have been betting against Tesla over and over and over again. What's going on here? Haven't you learned your lesson? The culties say 15,000. Mama Kathy says Tesla will go to $15,000 a share. Why would you want to fight Mama Kathy when the Holy Spirit is on her side? Anyhow, at number 3, PLTR, Palantir, another YOLO stock. It has been outperforming not just last week, but this week too. Excellent outperformer. And these options, by the way, call options, they're appreciating handsomely. Palantir, with about 550,000 contracts, about 75% of those were calls. And what about the unusual activities that took place in the options market today? Starting with the ticker XME, this is my favorite, the materials ETF, and they're betting for more upside here. I'm not sure. I got to see the dollar down big before I YOLO and go all in buying materials. But anyhow, somebody's betting for an upside here to come by buying the 44 calls with the expiration date of October 15th, with expectations that the XME will rise higher by more than 6% by then. They paid about 60 cents apiece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker IWM? Notice that the XME is being bid higher. The IWM is being bid higher. These are the cyclical trade. So are traders bidding for the revival of the inflationary / the reopening trade? We'll see. But here we have calls for the IWM by buying the 239, the expiration date of October 15th, with expectations that the IWM will rise higher by more than 6%. They paid about 32 cents apiece to enter this trade. All in all, spending about $400,000. What about the trade for the ticker DRI? Darden Restaurants, the operator of the Olive Garden, classy. The name popped higher today due to earnings, but somebody's betting for a top here by buying the 150 puts with the expiration date October 15th, with expectations that the name will drop by more than 6% by then. They paid about $1.50 a piece to enter this trade. All in all, spending about $1.8 million. What about the trade for the ticker ERJ? This is a Brazilian aerospace company, and it's popping higher, and they're betting for more gains to come by buying the $20 calls for the expiration date of November 19th, with expectations that the name will pop higher by more than 11% by then. They paid about 75 cents a piece apiece to enter this trade. All in all, spending about $750,000. What about the trade for the ticker AMC? You guessed it, AMC. The apes. The apes are not doing so hot but perhaps somebody's betting here for gains to come, a rebound, perhaps more news, new flavors for the popcorn, who knows. They're buying the 45 calls with the expiration date of October 1st, with the expectation that AMC will pop higher by more than 13% or more, and they paid about 85 cents apiece to enter this trade. All in all, spending about $800,000. Excuse me, $600,000. What about the trade for the ticker AEO, American Eagle Outfitters? They're betting for more gains to come here by buying the 29 calls, the expiration date of November 19th, with the expectations that the name will pop higher by more than 5% by then, and they paid about $1.25 apiece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker DKNG? There is a massive move that's about to happen in this name, up or down. The chart doesn't look good because we have a head and shoulder formation, but somebody's betting for massive gains to come here by buying the 57 calls, the expiration date of October 22nd, with expectations that DraftKings will pop higher by more than 10% by then, and they paid about $1.30 apiece to enter this trade. All in all, spending about $800,000. Moving on to the heat map analysis. Once again, everything is rising higher, with exception of the defensive sectors of the market, utilities, and REITs, along with, you guessed it, consumer defensives. I do like the rally here. Financials leading the market, along with energy, industrials, and materials. Of course, gold will always weigh down on materials, but we talked about that before. I'm not a fan of gold. I like aluminum, steel, copper, chemicals, fertilizers, these kind of names. Even the infrastructure names were rallying higher. The Martin Marietta, Vulcan were all surging higher. The industrials also rising higher. Deere, CAD, GE, the defense contractors all popping higher. Energy, Exxon, Chevron. But again, how can you confirm that this is a legitimate rally? I like the action, specifically that we're not relying on the big guys, Apple, Microsoft, Amazon, Facebook, Google, to get us higher. We're relying on the cyclical names. Chips, banks, oil, industrials, metals, reopening names. Look at names like TJ Maxx, Marriott, Ford, the cruises, hotels, all surging higher. But you got to keep in the back of your head, we have no confirmation. The dollar is still high. Yields still low. Or on top of that, we have warnings from FedEx, massive warnings regarding the labor shortage. And after the bell, we have Nike's earnings. And that's another disaster because Nike is downgrading the outlook due to stagflation. No labor, factory shutdowns, supplies are too high, too expensive, and this will impact the growth of Nike. And if Nike goes down, then a lot of other names will follow through. Stick around to the conclusion of this video because I have something very important for you. Moving on to the charts analysis, starting with the 30-minute chart of the SPY. A massive pop higher, and now we're reclaiming 443 as support. The gap is already behind us, but here's the problem. Look at the MACD indicator. We were expecting a crossing to the negative territory yesterday. It didn't happen. It rebounded higher once again. But now you're stretching it. Now we actually have a crossing, meaning the likelihood is this pop is now overbought when you look at the RSI, and we will start to trade down. Doesn't mean that we will flush down, we're going to crash again, but this is irrational when you drop down 3 to 5% and you rebound higher right away. We talked about this in the intro of the video. Back in January, the stock market dropped 3.5% on the COVID-19 scare over China. The market rebounded higher right away to all-time highs, and everybody started jerking off, orgasms all over the place. Shortage of Kleenex started even before the pandemic due to Wall Street jerking off. But what followed is a massive crash because you cannot ignore the facts. If what's going on with Evergrande in China will be indeed contagious, then we got a problem that you cannot ignore. For now, we have an $18 billion injection. We're kicking the can down the road, but does this solve the problem at all? If China gets shot, because somebody will end up holding the bag, folks. Whether it is Evergrande, whether it is the investors of Evergrande, whether it is the banks, the Chinese government, the bag is not going to disappear in a black hole. Somebody will end up holding the bag. Even if the Chinese government bails out Evergrande or nationalizes the company, now we have the Chinese government holding a massive bag worth $300 billion. And if the Chinese economy slows down, a lot of companies, US-based companies, will get shot. You heard what happened with Nike after the bill. What's next? Starbucks getting shot, McDonald's getting shot, Apple getting shot in China. You think the market will be able to rally higher and make new highs without Apple participating? Think again. The support for now is 443. The resistance remains at 447. The likelihood is we will breach the support. Perhaps we will go down all the way to 438 and take it from there. What about the daily chart for the continuous contract for the S&P 500? The rebound continues off oversold conditions. From both the RSI and MACD indicators perspective, we're starting to normalize here. We're getting back to normal, the average. The bulls need to see the candles climbing higher and reclaiming the trend line by tomorrow's closing, which is wild and probably not going to happen. The likelihood is you're going to drop down again, retag the support of 4,384.5, and then take it from there. The good news is that the volume is receding, meaning that the majority of the selling is behind us, at least for now. Moving on to the NASDAQ 30 minutes chart, what's going on here? Moving higher, but not as high as the SPY because the big cap technology names did not pop higher today. The majority of the rally was on the heels of cyclicals, inflationary side of the market. Financials, industrials, oil, etc. Yet the NASDAQ managed to close the gap. This is the good news. The bad news is we're getting stretched here. From both the MACD, the RSI perspective, perhaps we need a pullback and we have a wedge pattern. The likelihood is this will break down, breaching the support of 372. Even though the candlestick pattern is in a bull flag formation. But again, we've been fooled before, folks. When you have a certain candlestick pattern, bullish or bearish, but when you fail to combine that pattern with the momentum indicators, the MACD and the RSI, you make bad decisions. What about the daily chart for the continuous contract on the NASDAQ? The momentum indicators remain negative. Slight improvement here, but we still have a negative divergence on the RSI and the MACD indicators. The good news is we cut the losses by more than half, and the chart is now trading above 15,000 comfortably. Are we out of the woods yet? No, because we went to the gap, we closed the gap, and the chart closed the day below the gap. It doesn't mean that a reversal is coming, but it means that we have significant resistance at the gap. And the risk here, of course, is this pattern, a reverse ABC pattern. If it happens and we see declines starting tomorrow, perhaps going on toward next week, we will see the formation of the C leg. This is what the bears want to see, and this is what the bulls don't want to see. Moving on to the IWM 30 minutes chart, what's going on here? Climbing higher, leading the market, outperforming the SPY, outperforming the NASDAQ. These cyclicals were leading the market today. But again, way out of whack. From the momentum indicators, the MACD, the RSI, we've been pulled back when we traded at these levels before. Yes, the candlestick pattern is good, a bull flag consolidation, but you cannot trust it. The likelihood is you want to go down to 223, retest that one for support, and then rebound higher. And here it is, the most important chart of the day, the Dixie, reversing the move from yesterday. We discussed the reasons, the Bank of England with the hawkish stance, more hawkish than Jerome Powell. And today, the sterling rallied higher, along with the Canadian dollar, the New Zealand Kiwi, the Australian dollar, all rising higher. And this is adding a downward pressure on the dollar. But can you trust that the pop is over in the dollar? No, you cannot, because the momentum indicators remain hot and the dollar still trading above 93. If the dollar flushes down tomorrow and it closes below 93 by a lot, then we have a double top formation and we have a confirmation that the inflation trade will start to work out once again. But pay attention now. Here's the chart of gold, the mature guy in the room, flashing down. It perhaps will go down all the way to the next Fibonacci level of around 1,685, 1,680 within that zone. Of course, the mature guy in the room has a lot of enemies. including yields, and yields were surging higher today, but the dollar was down. So you could dismiss the price action as, oh, gold is just dropping due to the rise in yields. But I believe that gold is sending a message here that the dollar will start to reverse and move higher again. And here's the chart for the 10-year yield, a massive pop higher. The process of consolidation, back and forth, above 1.28%. That line has been respected throughout the consolidation. This is bullish. And the process of consolidation is a gathering of energy, and this energy will be released violently. And now it is being released higher. Yes, we have a resistance zone, but I don't believe that the chart will respect the resistance zone because the amount of energy is massive. We could see a massive pop higher here, perhaps above 1.5%, if not more. If that happens, there is a threshold, by the way, when the market is not going to be able to tolerate higher yields. If we go above 1.6 rapidly, you will see a massive crash in the Nasdaq and the high growth, high momentum names. Perhaps the only outperformer in the market will be banks, regional banks, specifically the KRE. But perhaps the most important message here is that if yields continue to pop higher, then the bond market is doing Powell's job for him. Powell says, forget about tapering, and most importantly, forget about raising interest rates. This will never happen. We need to have 1 trillion jobs opening, and perhaps inflation at 300% before we meet the substantial further progress for raising interest rates. But watch out here, because the bond market could do the job for Powell by shooting yields higher, 1.8, 2%, more than 2%, and the tightening will be done without the Fed even tightening, and this will be bad for stocks. Here's a weekly chart for the TLT. Not a good looking candle here. Still hugging 149, no conclusion at all. But if we see another flush down, the weekly closing way below 149, we got a problem here. In the TLT, the momentum indicators are weakening, flattening. Perhaps there is a message here that the bond market is about to send to Jerome Powell. Moving on to the VIX 4 hours chart, the most reliable indicator so far. The moment in the morning you looked at the 4 hours chart of the VIX and you looked at the MACD and you saw the negative crossing, the red columns on the histogram, you knew right away that the SPY is about to pop higher. Now, the real test will be tomorrow. Will we see the revival of Crush the VIX Fridays, or are we about to see the third week in a row where the VIX closes above 20? This will be a critical closing that I will be watching like a hawk. I closed my UVXY puts, which I bought for pennies on the dollar, and I went long the VIX, not buying calls in the UVXY, not buying the UVXY. Stay away from that toxic garbage. Never buy calls on the UVXY, only puts when volatility is about to drop down. The way you play the VIX higher is via buying SPY puts. What about Apple? What's going on here? Still rebounding higher, closing the gap, trading above 145, but still until and unless you close above the breakdown candle, the possibility of a bear flag pattern is still here. And if it is still here, the chart could flush down all the way to the end target for correction of about 15% from the top. What about Tesla? The souffle 30 minutes chart, popping higher, closing the gap, but struggling to break above the gap. Not necessarily bearish, still in a bullish formation, grinding higher, gathering energy, but at some point, if you fail to close the gap and trade above it, that becomes a bearish signal for a pullback all the way to 742. What about tulips? BTC daily chart building on the gains. I don't trust this rally either. I want to see a retest of 42,000. For some analysts, it is 40,000. That would be even better for me. If BTC retests 40,000 and rebounds higher again, then we have a double bottom, and I would be more than comfortable of going long tulips. But you have to also weigh in the news, because we have the Biden administration appointing a crypto hawk to run the OCC. Folks, I have a little birdie that told me we have an imminent crypto crackdown, and it will come with coordination with the SEC, the OCC, the Treasury Department, the Justice Department. And once that crackdown happens, goodbye tulips. So you got to be really careful here. What about AMC? Not a good looking chart, failing to rally higher. failing to close above 42.5. We still have one more day to go for the week, but this is not a good looking chart, folks. From a daily perspective, from a weekly perspective, I know the apes don't like it when I speak negatively about AMC, but what do you want me to do? Sugarcoat it for you? Not in this channel, baby. We played AMC up and down. There are times when the chart goes higher and we traded higher. This is not one of these times. You gotta watch out and see how the chart reacts at 32. If it rebounds higher again, then we got a long trade. But for now, the short trade is the winning one. 42.5 remains resistance, 32 remains support. And we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Nothing important at all. We have new home sales. Existing home sales disappointed. The likelihood is new home sales will also disappoint as we see cooling down in the real estate housing mania. But here's what I want to leave you with. This is a heat map for the stock market performance a year ago. So 1 year performance. Pretty much every stock in the market is lighting up green. You have to be the biggest dumbass in the world to lose money in this market. For example, if you bought Alibaba, if you placed your chips on Zoom or gold, yep, you lost money. But you could have put your blindfold on and placed your chip anywhere in the roulette table and you scored big. This is the easiest market in history. Now, let's skip to a year-to-date performance. We're seeing some more names here getting shot. More red. This is how bubbles end. Read the work of Jeremy Grantham. Crashes don't happen all at once. Everything crashes all of a sudden. One shot down. No, this didn't even happen during the dot-com bubble. At the beginning, we saw the high mania, high growth names getting shot. Then the bubble favorites, the Qualcomms, etc. And then the big ones, the big shots, the Microsofts, the Ciscos. It's a gradual process. So we went from 1 year ago to year to date, and we're seeing more names getting shots here. What about the 6 month performance? Now we're seeing more names getting shot. And who's holding? The big guys. Apple, Microsoft, Google, Amazon, Tesla didn't get shot yet. Let's move on to a 1 month performance. More names are getting shot here. The cyclical trade is getting shot. The big cap technology stocks are getting shot. Healthcare is getting shot. And very few names are still outperforming. It's a gradual process, but it's a matter of time before the entire market gets shot. And with that, ladies and gentlemen, this is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.